Good afternoon, everyone. Thank you for joining us. We're excited to spend a little bit of time this afternoon giving a high-level overview of key issues to be aware of in managing family foundations. I'm Sarah Duniway. I'm the chair of our nonprofit and tax-exempt organizations group. I'm joined by two great colleagues, Ruth Brackney and Catie Bitzan Amundsen. Ruth is in our trust and estates group, and Catie works with me in our nonprofit group. And family foundations are an area where our two practice areas overlap. Catie and I come at it from the organizational side, and we work with a wide variety of nonprofits, including many foundations and family foundations. And Ruth comes at it from the estate and legacy planning side, working with families in their estate planning, which often includes then setting up and running family foundations. So we're excited to present the content today. And like Stephanie said, if you have questions, please put them in the chat. We'll do our best to get to them at the end, and if we run out of time, we welcome you to email any one of us, and we'd be happy to talk to you about your questions. Next slide, please. So just a quick overview of our agenda. We have a half hour today, so we're going to move through things pretty promptly. I'm going to spend just a couple minutes on some legal basics. Always a fan of starting at the beginning. Hopefully much of that will be review for all of you, but go over those basics, and then I'll hand it over to Ruth, who's going to walk through the key rules that are applicable to private foundations. We'll turn it over to Catie to talk about governance structures and best practices, as well as some practical matters. Next slide. So starting at the beginning, some legal fundamentals. When we talk about family foundations, they usually have three characteristics from a legal standpoint. The first one is that they have some kind of legal form. So they would almost always be either a nonprofit corporation or a charitable trust. These are state law concepts. They're very similar in practice. There's some distinctions that matter from the technicalities of the legal structure, but the general concept is similar in that nobody owns it. There's no shareholders or somebody with a financial interest in the organization. There's generally a governance structure. A board of directors is the term we usually use on the nonprofit side, or board of trustees on the charitable trust side. The boards can act and make decisions and so forth. So those are all concepts that are governed by state law and matter whether it's a nonprofit corporation or the charitable trust, just to know what body of rules we're looking at when we're answering those governance questions. They are also typically subject to Attorney General supervision. Most states have some form of supervision of charitable organizations that rests usually in the Attorney General's office. Then family foundations are also tax exempt as 501c3 organizations. That's a status that's recognized by the Federal Internal Revenue Service. The key characteristics of C3 status is that the organization has to be operated primarily in furtherance of its charitable purposes, or in English, its mission, and that they need to be operated for the benefit of the public. And any private benefit is only incidental to that public benefit, the charitable good that the organization is pursuing. And then when we're talking about family foundations, they are going to typically also be considered a private foundation, which is a subclassification of 501c3 status. And there are some additional operating rules and restrictions that apply to foundations that are in that private foundation category. And that's the stuff that Ruth is going to be talking about. Next slide. So just to draw a picture of the world of 501c3 organizations and where private foundations fit into this, it's important to understand these distinctions, both to know what you are as a foundation, but also some of the rules that we talk about in terms of grant making and other interactions with organizations also call upon these categories. And so important to have an awareness of this overall structure of the way the world of 501c3s are organized under the tax code. So you've got the big category of 501c3 organizations. And then within that, there's two sort of big subcategories, what we call public charities and then private foundations. So on the slide, you see on the left, public charities, and on the right, private foundations. There's two subcategories then of private foundations. There's what we just call normal private foundations, and then there's a smaller group called private operating foundations, and smaller by the mean, I think they occur less often. They are also private foundations, but instead of primarily doing grant making, they actually run charitable programs, and there's some slight variations in the rules that would apply if it's an operating foundation. Private foundation status is simply math calculation based on the sources of financial support. So if a foundation's financial support annually is primarily from one or a small number of donors, or from its endowment or investment earnings, it will be a private foundation. On the other side of the bucket, we have public charities, and this is what many people think of as sort of charitable organizations or nonprofits. They, and there's of course subcategories within those. The one on the far left is a 170B1A6, and those are organizations that are primarily supported by donations from a broad cross-section of the community. So again, it's a math calculation, but organizations, that raise a lot of dollars from a lot of different donors will typically qualify and fall into that category. There's a second sort of similar category of organizations whose sources of financial support are derived from the conduct of their charitable activities. So for example, many healthcare organizations are 509(a)(2)s. There are a handful of organizations that get to be public charities just because of what they do, so not based on their financial support. Those are churches, hospitals, and schools. And of course, what those definitions are matter, but that's enough for today's discussion. And then there's the third type, which is called supporting organizations, and they get their public charity status because they have a close relationship to one of the other three that I just talked about. Public charities are all permitted grantees for private foundations, so that's why it's relevant and important for foundations to know and understand those categories. I forgot what my second point was, so it doesn't really matter. I was going to say they're not subject to the additional private foundation rules. They're still subject to all the general rules that we talk about for 501c3s, but they're free from all the rules that Ruth is about to talk about. So it's considered sort of a preferred status, but also a really important part of the charitable sector. So with that, I'm going to, oh no, I have one more, sorry. Next slide. The final piece of the sort of basics is just a reminder on how state and federal registration and reporting work for foundations. So as I mentioned at the beginning, many foundations are set up as nonprofit corporations. That requires an initial incorporation with the Secretary of State's office or the Department of State. They have slightly different names depending on which state you're in. And then typically will require some kind of annual renewal of that nonprofit corporate status. Most states also require registration with the Attorney General's office. That's the office that supervises charitable organizations. There can be exceptions depending, based on how much money the organization has, and the state rules vary a little bit state to state, but the general concept is this is where state regulation comes in and oversight over charitable assets. And there's usually some kind of annual reporting, typically including a copy of the tax return that gets filed then with the state. And then on the IRS side, to get 501c3 status, there's an initial application and determination process. And once that is granted, then there's an annual tax return, the IRS form 990-PF, that gets filed annually. And with that now, I'm going to hand it over to Ruth in the next slide.
Thank you, Sarah. So as she mentioned, I'm going to talk about some of the rules that govern a private foundation and how they may operate. And it's very important to be aware of these rules because if you violate these rules, even if it's unintentional, there's very hefty penalties that are imposed. So, we always recommend that if you have a question about something before doing it, you ask us and we can tell you whether or not that's allowed. So the first one is there's a prohibition on self-dealing between a private foundation and disqualified persons. So disqualified persons include the substantial contributors. So those are the people who set up the foundation. Also any foundation managers, which consist of board members if you're set up as a corporation, or the trustees if you're set up as a trust, and then family members, so of the substantial contributors. So that would be like children, spouses, grandchildren, great-grandchildren. It does not include siblings. So that's something to note. There's also an exception, or disqualified persons also include like corporations and partnerships, which are owned 35% or more by disqualified persons, and trusts where beneficial interests are held by more than 35% of disqualified persons. So different kinds of acts of self-dealing include the sale, exchange, or lease of property between a private foundation and a disqualified person. There is an exception for a lease of office space, or I'm sorry, yeah, there is an exception for a lease of office space to a private foundation for zero rent. A second act of self-dealing is a loan or extension of credit. There is also an exception for zero interest loans to a private foundation from a disqualified person. Furnishing of goods, services, and facilities to a disqualified person by the private foundation is also an act of self-dealing. Now, there is an exception if it's something that's made available to the general public on the same terms. An example of this would be like if there's a park, you know, a disqualified person is able to go to that park because it's made available to the general public. The payment of compensation that is excessive, or reimbursement of expenses that are excessive. So there's an exception, obviously, in that if it's reasonable compensation or reasonable expenses related to carrying out the duties of the foundation. This is one that's pretty commonly asked about, and that's the use of tickets at like galas and fundraising events and golf tournaments. So that is not allowed. Now, there is an exception if there's the cost of attendance, which is different than a lot of people think that if they pay the non-deductible portion of the ticket, that's okay, but it's really the cost of attendance, so it's a little bit different. So that's something to be aware of. The exception would be like if it's an event that's related to the foundation's purpose or educational, then there might be some exceptions to that rule. The next one is another really important one, is the satisfaction of personal pledges. So I get asked this a lot of times if somebody has a personal pledge that they made to a charity, you know, whether or not their foundation can satisfy that pledge, and it's not allowed. That is definitely an act of self-dealing. Another exception to the rule as far as sales, which I see a lot in our practice, is there's an exception during the administration of an estate or trust. And what I've found is sometimes when you have a residuary bequest to a foundation, there's some assets that are undesirable. So, you know, the only option to sell those assets to might be to a disqualified person. So there's actually a procedure where you seek probate court approval, and you're able to get approval to sell that asset as long as it's for fair market value. The interest received has to be at least as liquid. And there's a couple other rules, but we've been able to do that several times here when we have an asset that we want to not end up in a foundation when someone dies and they're leaving a large amount of assets. Maybe it's a partnership interest in a kind of a family entity or something like that. So that's something to be aware of. Next slide. So the next rule is the minimum distribution requirement. And in general, this means that 5% of the average value of the assets in the prior year are required to be distributed to charitable purposes within by the end of the last day of the next taxable year. Now, some of the costs of administration of the foundation go into that. So that's something to be aware of. Sorry, I can't always read everything. The next one is qualifying distributions. So distributions to charity qualify for this. If it's a non-public charity, then you have to have expenditure responsibility, which just means that the foundation has to make sure that the grant is used for its charitable purposes. So next slide, please. Something that's very important is making sure that lobbying and political activities are not done by the private foundation. Sorry, I have like a frog in my throat. So lobbying includes things like influencing specific legislation, intervening in campaigns and things like that. The next rule to be aware of is the excess business holding limitation. So foundations are not allowed to own more than 20% of a business enterprise. That cap includes all disqualified persons. So the 20% includes if there's all disqualified persons that own an interest in that business enterprise. Also, there's a de minimis exception, which is 2%. So you can own up to 2% of a entity, and that's okay. Jeopardizing investments. So the foundation has to act prudently when it comes to investments. There's some things that are scrutinized on audit, which include things like trading securities on margin, trading in commodities futures, oil and gas wells, selling short, and the purchase of warrants, puts, calls, and straddles. Next slide, please. Oh, I think you went too far. Oh, I'm sorry. Okay, excess business holding exception. I forgot about that one. Oh, I'm sorry. I did talk about that one. I'm sorry. So the last thing I was going to talk about is there's some taxes that are imposed on the foundation. Just to be aware of, there's a tax on unrelated business income and an excise tax on net investment income, which is equal to 1.39% of the net investment income for the foundation. So with that, I think it is next to go to Catie. Thank you.
Perfect. Thank you, Ruth. So I am going to be wrapping us up. And you know what? It looks like we are moving a little bit ahead of time. So perhaps it looks like we just got a question in the chat, Ruth, to you that is related to something you just spoke to. So maybe let's take a moment and address that. If a disqualified person makes a pledge to a church, places the funds into the foundation, and then issues those funds to the church, is that considered self-dealing? Are you able to speak to that one, Ruth?
So if it's a pledge that's made by the disqualified person, then that cannot be satisfied by the foundation. So I'm not quite sure if it's an existing pledge and the funds are placed into the foundation, you still cannot satisfy that with the foundation, any existing pledge. It has to be a pledge that's in the name of the foundation.
Great, thank you. So I am going to then wrap us up with this discussion of these last pieces: governance structures, best practices, and some practical considerations. And for family foundations, I think there's really a good opportunity for customizing the governance structure to fit the family and its dynamics and its goals. There's really a lot of room for creativity and flexibility in this space. So if the foundation is a nonprofit corporation, then it's one kind of body that's permissible, but it's not required, is having members are in addition to the board, and members typically have certain reserved rights. It's very common for them to have a right to approve amendments to the articles and bylaws. Oftentimes they appoint the directors. They might approve certain decision-making by the board too, such as appointing officers or approving grants. And one way that we've seen the member structure be used in a helpful way is to have the founders of the family foundation serve as the members, and then a broader contingent, I guess, of the family or even the next generation serving as the board, and perhaps along with those founders. And that kind of structure lets the founders really involve a broader group from the family or the next generation, but while retaining significant reserve powers and oversight and really ultimate control over the foundation. Another group then is the board of trustees or board of directors, and they really engage in the ongoing oversight of the organization. So they serve as the governing board. They typically approve grants and are reviewing financials and are really making those significant decisions on behalf of the foundation. And then the officers are charged with carrying out the day-to-day management of the foundation. So president, secretary, treasurer, or others. But as I mentioned, there really is room for customization and creativity here. So one thing we often see is grant-making authority that's actually allocated across different family or among different family branches. So families might have kind of a natural geographic separation or perhaps different philanthropic interests by branch. And so, you can create these different family grant making structures that should be formalized either in the bylaws or sometimes in board resolutions. But that can be kind of a helpful way to broaden and approach grant making creatively in the foundation. As I mentioned too, the use of both members and a board is something that can be appropriate for a foundation. And it might only be used for a certain point in the foundation's, the life of the foundation as well. You can transition as a nonprofit corporation into having members and then out of having members as well. So it might just be a governance mechanism to help with a certain transition or for a certain period of time, or at the beginning of the foundation, but ultimately the members might roll out and you would just have a board governing going forward. The next one is the use of advisory boards. So a foundation can create advisory boards that don't ultimately have decision-making authority, but can really provide input to the main board on grant making, on programmatic activities. And this might be composed of family members. Certainly if there's a very large family, we've seen that used here. Again, a next generation kind of integration technique. Community members who are not necessarily family, but getting broad input and perspective from experts and others and leaders in the community. And also persons with lived experience who are served or either represent or potentially or have some interaction with the community served by the grant making of the foundation and getting their input as well. And at some point in time looking forward, it might be appropriate to consider what is the next iteration of the foundation. And that can look like a few different things. It might be dividing the foundation formally among family branches, dissolving the foundation and becoming a donor advised fund, or really a blend of these, and perhaps a blend of these by family branch to continue the family's philanthropy. Let's go to the next slide. So we often conduct what we call well-check reviews of our foundation clients. And so this is reviewing their core legal documents, filings and practices, and doing some legal issue spotting. And what we framed up here are just some of the key issues that we tend to run into most often, probably in those reviews, that can be brushed up by adopting some best practices. And the first is importance of corporate formalities. And here it seems simple, but really holding regular meetings, that can seem strange with just family members, a few or a couple of family members, but it is important. We typically recommend generally 2 meetings per year, but if the foundation is a lot more active in its grant making and other opportunities and needs to make decisions more frequently, those should absolutely be and can be held more often. And they don't need to be really formal affairs, but they should be written down and then retained as minutes of that meeting. And the minutes should reflect the board's discussion and the key decisions by the board and should all be kept in one place. Sometimes the governing documents will allow boards to take written actions, so including via email, which is very helpful nowadays. And then those emails, if that's done and the board votes and approves via email, those emails should also be kept with the corporate records as official records of decision making. Another problem area that we see is clarity around who has authority to make grants on behalf of the foundation. So, it may be that the board wants to retain the authority to approve all grants, or they might want to delegate grant making authority to some degree or completely, but really usually to some degree to a committee or vetting, to being done by an officer at certain dollar thresholds, for example. But a donor so say perhaps the key donor or substantial contributor does not have the authority to make foundation grants in that person's capacity as the donor. So if you want that donor to have the authority to approve grants, the better way and really the best practice is to delegate that authority to that individual as an officer of the foundation and formalize this in board resolutions so that it's really clear that when that person is approving grants, they're acting as an officer on behalf of the foundation and they're not acting in their personal capacity. And along the same lines, it's important to have really clear separation between the family and the family business and the foundation. And Ruth spoke to this a bit as well. So pledges and sponsorships, when they're entered into, should be entered into by the foundation itself. Family members, as Ruth mentioned, can't make pledges that are then fulfilled by the foundation because it's considered that the foundation is really fulfilling a personal obligation of the individual. So I think this presents a good opportunity for education of family members about when they're acting in their personal capacity versus their official foundation capacity. And that clarity can really help avoid a number of self-dealing issues. One thing that we found helpful too is to have some essentially self-dealing tools on hand, summaries, decision trees, checklists, that kind of thing, as a how to do this and what to do and how to do guide, how to make pledges, how to approve grants, that really help the family understand what it means practically to operate alongside their foundation. Next slide. And finally, a few practical matters that we often come across that can benefit from some brush up. The first is that any contracts and correspondence by the foundation should really be done by the foundation in its own name. And with respect to contracts, those should be signed by an officer of the foundation, not the donor as the donor. So if the main donor to the foundation signs a contract, that's okay, but it shouldn't be as donor, it should be as that person's official title as an officer of the organization. For accounting purposes, the foundation should have its own books and records. It's a pretty clear one. One other thing to note is that there are state audit requirements for charitable organizations. In some states, they require an external audit if you have above a certain amount of assets. And those rules vary a little bit by state, but worth checking out and making sure that you're in compliance with those. It's also important to substantiate donations to the foundation correctly and provide receipts to donors so that they have them for tax purposes. There are also special rules around when appraisals are required if a person will be donating an item above a certain dollar value and taking a deduction, so we're paying attention to those. And then, having grant making documentation in place is the last piece I wanted to cover. So grant letters, grant agreements, kind of setting forth the key terms for purposes of clarity among all parties with the grantees, especially around what reports they need to be making to the foundation. And, as Ruth mentioned earlier too, for grants to nonprofits that are to nonprofits that are public charities, really, capturing the key terms like the grant period, the amount, and the purposes. But as far as the detail of those grants, I think it's really a balancing act of, for reporting purposes, what information do we need for purposes of oversight, really understanding the impact of your grant, versus also being intentional about what kind of burden you're placing on the grantee with respect to unique reporting requirements. And then it will be more bulked up if the grant requires expenditure responsibility to demonstrate that the foundation is sufficiently overseeing that grant. And next slide. With that, I think we will wrap up our truly lightning round style presentation. Thank you so much, everyone, for joining us. Our contact information is here, and please don't hesitate to reach out to any of us if you have questions. We love advising family foundations and would just be delighted to connect with you on anything that we've discussed today. Thank you.